We are pleased to be joined by Austin Goolsbee, Chicago Fed President. Austin, thanks for joining us this morning.
Yeah, great to see you again, Steve.
I hope you're happy to be the first guy out of the box to talk about this jobs report, which is, double the estimate? How does it make you feel about, first of all, the U.S. economy, and I think, second of all, whether or not jobs are increasingly representing a source of potential inflation to you?
Well, I think you're never going to hear me complain that we got 250,000 jobs. I think it's a strong jobs report. It makes me further comfortable that the job market is stabilizing at something like the full employment rate, that as we went through the fall last year, there were some danger signs. You had seen the unemployment rate ticking up for a fair bit, and now that's stabilized. It's even come down a little bit. So I think that part is strong. I think there's still a couple of question marks about over-indexing on individual job months. As you know, we've been up, we've been down, we've had hurricanes. Now we got fires. We'll have to see what that's going to do to the numbers. And we had quite a strong Christmas season. And if you look in these jobs numbers, you had a very big positive private sector job growth in the retail sector. So we're going to still have to process through, was that a sign of the season and then it will slow down, or is that a sign of general consumer confidence and consumer spending is going to remain strong going through the beginning of this year?
Austin, the chair and others as well have said that they do not see the job market as a source of inflation. Is that changing in your mind?
That has not been changing in my mind. I don't see it as a source of inflation. If you look at wages for 2024, I think the wage number was 3.9% growth. That's pretty close to consistent given what productivity's been running with 2% inflation. So thus far, to me, the job market looks like stabilized at full employment, not an indication of overheating.
There's so many things to ask you about. I know my colleagues are eager to do so, but one more from me, Austin. And you have interest rates really going the other way. Is that consistent with your outlook and what the economy needs? Is it something that the Fed needs to address? And how do you explain why the Fed cuts rates in the long end has gone up so strongly as it has?
Well, look, if you look at the long rate, for the people who say that's because of expected inflation, that can't really explain it. If you take the TIPS measures of what inflation expectations are, that explains at most maybe a third of what's been happening. I think some significant component is factoring in that if growth is going to be higher than what people thought, the Fed's the speed at which the Fed is going to be reducing down to neutral is slower than what they thought is going to be a more shallow rate path, if you want to call it that. And so that will affect long rates because they're just adding up a whole bunch of short rates. And I think there's a fair bit of uncertainty about policy, coupled with, as Sarah was saying, you've seen an uptick in some business confidence. And if you think the growth rate is going to be higher, I think that could be contributing to it as well.
So do you still want to be cutting rates this year?
Look, it's not what we want. It's what will the conditions authorize or justify. I still think, look, for all the discussion about inflation, if you take PCE inflation, which is our 2% target, and you ask over the last 6 months, what has inflation been? The answer is 1.9%. Through all of the bumps, the inflation rate since the bump in first quarter of last year, we've seen pretty stable inflation that's been coming in around where the target is. Even the core has come down. I think the last 6 months core is about 2.2. So if conditions are stable and we don't have an uptick in the inflation rate and we keep having them come in around 2% with stable and full employment, I think that the rates should go down to where to what I consider to be neutral. And so 12 to 18 months from now, they would be a fair bit lower than they are today. The thing that will
So that's a yes.
explain, justify the speed at which we do that are going to be what happens to conditions.